Have you ever wondered why gold keeps breaking record after record while nobody in the mainstream media can give you a straight answer about what is really happening? And more importantly, why does this exact same pattern show up in history right before entire financial systems collapsed and wiped out the savings of ordinary people who had no idea what was coming? I need you to stay with me for the next few minutes because what I am about to share with you is not just another gold story. This is a warning that history is trying to give us, and most people are too distracted to hear it. If you find even one insight here that changes how you look at your money, do me a small favor, hit that like button, tap subscribe, and share this with someone you care about. Because the people who understand what is happening early are always the ones who protect themselves in time. Let me take you back to a hot summer day, August 14th, 1971, a place called Fort Knox in Kentucky. There's a man sitting at his desk. His name is Kenneth Dam. He is 44 years old. He works for the United States Treasury. And on that particular afternoon, he is holding a phone in his hand and having a conversation he will remember for the rest of his life. Decades later, when he becomes an old man, he will still call it the strangest professional conversation he ever had. On the other side of that call is a representative from the French government. And the French are asking for something very simple, something they have every legal right to ask for. They want to trade their United States dollars for gold. Not a small amount, $191 million worth of gold. And under an agreement signed back in 1944, called the Bretton Woods Agreement, the United States had promised to hand over gold in exchange for dollars whenever a foreign government requested it. That was the deal. That was the promise. That was the foundation of the entire global money system after World War II. But here is the problem. When Kenneth Dam picked up that phone, he already knew something the French did not. He knew that the vaults of Fort Knox and the Federal Reserve did not have enough free gold left to honor the request. Not without setting off a panic. Not without triggering the kind of financial run that Nixon's advisors had been losing sleep over for months. So Kenneth Dam did the only thing he could do. He politely told the French that the conversion could not happen right away. He did not explain why. He could not explain why. Because if he had told them the truth, the whole world would have known within hours that the emperor had no clothes. At that moment, the official price of gold was fixed at $35 per ounce. That was the government's price. That was the promise. But out in the real world, in the open market where actual buyers and sellers met each other, gold was trading at $44 per ounce. That gap, that $9 difference, was not just a number. It was a signal. It was the market's way of saying that the official story was a lie, that the number the government kept repeating had no relationship to reality anymore. 3 days later, on a Sunday evening, President Richard Nixon walked in front of a television camera and spoke to the American people. In a calm and steady voice, he announced that the dollar would no longer be convertible into gold. Just like that. The core promise that held up the entire post-war financial world was gone. Erased. Canceled by a single announcement. And here is what happened next. That $35 official price, it became meaningless within hours. By 1974, gold was trading at $180. By 1980, it hit $850. Now stop and think about that for a second. Gold did not suddenly become more valuable. Gold was the same metal it had always been. What actually happened was that the dollar was losing its value at a speed nobody was ready to admit. And the rising price of gold in the years leading up to that Sunday night was the market screaming a warning that hardly anyone bothered to listen to. The warning was this. The official story, and the actual arithmetic underneath the system, had drifted so far apart that they could no longer be held together by promises and press conferences. Now here is why I am telling you this old story. Because gold is doing the exact same thing right now, in this very moment. And almost nobody in your feed is reading the signal the right way. Before I go deeper, I want to ask you something honestly. If this kind of context is what you have been missing from other channels, then take 2 seconds and drop a comment below with just the word listening. That single word tells the algorithm that this content matters, and it helps me bring these lessons to more people who need to hear them. That is your CTA for this section. Just one word. Listening. That is all. Now let us go deeper. To really understand what gold is trying to tell us today, you have to understand what gold actually measures, because it is not what the news anchors say it is. It is not what most finance influencers claim it is. Gold is not really an inflation hedge. I know that surprises people. But if you look at the actual data over short and medium time periods, the correlation between gold and consumer inflation is messy and inconsistent. Sometimes gold rises with inflation. Sometimes it falls while inflation climbs. It is not the reliable relationship that everyone assumes. Gold is also not really a safe haven in the way people describe. When stock markets crash hard, gold often falls along with everything else. Because in a real panic, people sell whatever they can to raise cash, and gold gets dumped just like anything else. So what does gold actually track? Over the long run, gold measures one specific thing with almost eerie consistency. It measures the distance between what a money system claims about itself and what the numbers underneath that system are really saying. It measures the gap between the story and the truth. Let me show you what that looks like in practice. Back in 1968, gold started slowly climbing above $35 in the London market. That was the unofficial market where governments could not control the price. First it went to 36, then 38, then 42. Each little jump was the market pricing in another dose of doubt. Another degree of skepticism about whether the United States could really keep its promise to give up gold at $35 an ounce. And that skepticism was not paranoia, it was math. The United States was spending massive amounts of money on the Vietnam War. It was also pouring money into new social programs known as the Great Society. That combination was flooding the world with more dollars than the American gold supply could ever back up. The French leader Charles de Gaulle understood this clearly. He was not being hostile. He was being logical. He literally sent ships full of dollars across the Atlantic Ocean to New York and demanded gold in return, because he knew that gold was worth more than $35, and that the promise would eventually collapse under its own weight. The people buying gold above $35 back then were not gamblers looking for a quick score. They were doing the same cold calculation that Kenneth Dam was doing in his office. They just did the math a few years earlier and moved their money accordingly. Gold went from $35 in 1968 to $850 in 1980. Not because the world suddenly went crazy, but because the credibility of the money system finally got priced honestly. The lie finally caught up with the truth. Now watch what gold is doing today. And I want you to pay less attention to the exact price and more attention to the behavior of the price, because it is the behavior that tells the story. In most of 2022, gold was trading somewhere around $1,800 per ounce. Then in late 2023, it broke through $2,000. In the middle of 2024, it powered past $2,500. By early 2025, it smashed through $3,000, and it has not stopped. Every level that experts said would be the top, the ceiling, the peak, gets shattered within months. The path is not slow and steady, it is accelerating. And that acceleration is the tell. That is the signature of a system under strain. Now, what do the experts tell you? They say gold is rising because of inflation. But wait, inflation in 2024 and 2025 came down a lot from its 2022 peak. If gold were really just an inflation story, it should be cooling off. Instead, it is going the other direction. Then they say gold is rising because of geopolitical tension, wars in Ukraine, conflicts in the Middle East. But those tensions have been there since 2022. Gold's real acceleration started separately and picked up speed even during quieter periods. So that explanation does not hold up either. The real explanation is much bigger. And once you see it, you cannot unsee it. Gold is measuring the gap between two very specific things. On one side, the dollar's claim to be the world's reserve currency, the unshakable global anchor, the one asset that every central bank on earth trusts more than any other. On the other side, the actual financial condition of the country that issues that dollar. The dollar's status as the world's reserve currency rests on an unspoken promise that the United States will manage its money responsibly, that its debts will stay under control, that its purchasing power will remain reasonably stable across the decades. This promise is not written in any treaty. It is the invisible assumption that the whole global financial machine runs on. It is the modern version of the Bretton Woods promise from 1944. Now here is the moment I want you to remember. In November of 2024, the credit rating agency Moody's downgraded the United States credit outlook. That single event is the modern version of Kenneth Dam's phone call. It is the moment an official institution stood up and quietly admitted that the promise cannot be honored the way it was originally made. Look at the numbers. Federal debt has crossed $36 trillion. It is growing by roughly $2 trillion every single year. Interest payments alone now exceed the entire defense budget. Let that sink in. The United States is spending more money on interest than on its military. This is not the financial condition of a country whose currency can quietly remain the safest asset on earth. This is the profile of a system heading toward a serious transition. Moody's just measured the gap between the official story and the arithmetic, and gold breaking through $3,000 is doing exactly what London gold did when it broke past $35 in 1970. It is not the crash, it is the pricing of the crash that is coming. I want to pause here for one important reason. If you are still with me, that means this content is doing what it should. So here's my second ask, and it is different this time. I want you to imagine one person in your life who is close to retirement or already retired, someone who has spent their whole life saving carefully. Send them this video, not the link to another finance guru. This video, because the information here could genuinely change how they protect what they have worked for. That share is worth more than 100 likes to me. Do it before you forget. Then come right back and let us keep going. Now let us talk about what a system break really means. Because this is not really a story about gold. Gold is just the messenger. The real story is about the architecture of the global financial system. The Bretton Woods system did not break in 1971 because gold was some special magical metal. It broke because the system depended on a specific commitment that the United States could no longer keep while also funding its wars and its domestic programs. The commitment and the spending were pulling in opposite directions. The two could not exist in the same world for long. And when the contradiction became too obvious to hide, the system snapped. The current global system rests on a very similar contradiction. The dollar's role as the world's reserve currency requires the United States to maintain fiscal discipline. But the actual spending required to keep up with Social Security, Medicare, defense, and interest on the debt is completely incompatible with that discipline. The commitment and the spending are once again pulling in opposite directions. And once again, the market is starting to notice. Gold breaking 3,000 is the market pricing the contradiction. It is the same signal the London market was sending in 1970. It is the exact same warning wearing a different suit. Now you might ask, why has the system not broken already? Why is everything still functioning? Why do prices at the grocery store not reflect any of this? The answer is institutional inertia. That is a fancy way of saying the global system moves like a giant ship. Even when the captain sees the iceberg, it takes time for the ship to turn or stop. The infrastructure of dollar dependence is enormous. Oil is priced in dollars. Most global debt is issued in dollars. Central bank reserves are held in dollars. International payments run through dollar-based banks. Countries do not just wake up one morning and switch reserve currencies. The cost of switching is huge, and the alternatives are still being built. But here is the lesson from 1971 that everyone should pay attention to. Once the London gold market started consistently trading above the official price, Bretton Woods had about 3 years left. 3 years. That is how long it took for the market's pricing to force the system into its final crisis. Once the signal is loud enough to be public, the countdown starts. Gold at $3,000 in 2025 is not the same as gold at $35 in 1968. That was the beginning of the warning. Where we are now is more like gold at $42 in late 1970. It is the phase where smart institutions have already stopped pretending, where the question is no longer whether the system changes, the question is when. Let me give you the evidence that this is not a normal gold rally. This is not just traders getting excited. This is something structural. Central banks around the world have been buying gold at record levels for 5 years in a row. And I want you to notice who the biggest buyers are. China, India, Turkey, Poland, and a long list of emerging market central banks. Every single one of them has been reducing their dollar reserves at the same time they have been increasing their gold reserves. These are not retail traders on a phone app making speculative bets. These are sovereign nations, governments, institutions with time horizons measured in decades, and they are all quietly doing the same thing. Back in 1968 and 1971, it was France and Germany asking the United States to hand over its gold. Today, in 2020 through 2025, it is China and India buying gold directly on the open market. The mechanism is different. There is no convertibility promise to enforce anymore, but the logic underneath the action is identical. These are sovereign players who see the gap between the dollar's official story and its fiscal reality. And they are quietly positioning themselves for what comes next. When central banks that hold trillions of dollars start reducing those holdings and buying gold together, they are not making random decisions. They are collectively doing what France did in 1970. They are pricing the truth instead of accepting the story. Consider this stunning fact. In 2001, the United States dollar made up 72% of global reserves. By 2025, that number has dropped to about 58%. That is a massive shift. And it did not require some dramatic Sunday night announcement to happen. It happened quietly, in stages, in shifts of a fraction of a percent here and there. The destination is already visible on the map, even if the sudden crash has not happened yet. Let me hit pause and ask you a real question. Are you starting to see why this matters? Not for some abstract country you have never visited, but for you, for your savings, for your retirement, for the money you have quietly stored in your bank account, thinking it would always be safe. If you are, then here's my next request, and this one is different from the last. I want you to click that subscribe button right now if you have not already. Not because I need the number, but because you deserve to hear the next warning before it becomes tomorrow's headline. The channels that show up in your feed shape what you understand about your money. Make sure the ones that are trying to protect you have a seat at the table. subscribe, and then come back for the second half. This is where it gets real. Now let us talk about you, because so far we have been discussing history and central banks and big numbers. But the real question is what any of this has to do with your bank account, your savings, your future. Here is the uncomfortable truth. When a currency system goes through a transition like this, ordinary people almost always suffer the most, not because they did anything wrong, but because they trusted the system to protect what they saved. And systems in transition are terrible at keeping that promise. Think about what happened to Americans between 1971 and 1980. If you had put $10,000 in a savings account in 1971, by 1980, that money had lost more than half of its purchasing power. Not because your bank cheated you, not because you made bad choices, but because the currency itself lost its value while you were sleeping. The paper stayed the same. The number in your account stayed close to the same, but the buying power melted away. The house you could have bought for $25,000 in 1971 cost $75,000 by 1980. That is the silent theft that no one talks about. That is what a currency transition feels like on the ground. It does not arrive with sirens. It does not send you a letter. It shows up slowly at the grocery store, at the gas pump, in the rent that keeps climbing, in the insurance premiums that never stop rising. And by the time you feel it fully, the transition is already complete. Now think about the position of the average saver today. Interest rates on savings accounts have improved a little bit, but they still barely keep up with even the reported rate of inflation. Real inflation, the kind you feel at the checkout counter, is often much higher than the official number. Meanwhile, the debt of the country is growing faster than the economy. That means the currency in your account is being diluted faster than it is being backed by real value. You are, without knowing it, already in a slow-motion currency transition. And gold is telling you about it every single day. Every new record high is another silent message. Every dollar it climbs is another sentence and a warning that has been going on for years. The people who understood the message in 1968 and moved their savings into hard assets ended the decade with their wealth intact. The people who ignored the message and kept everything in cash-based savings watched their life's work quietly evaporate. Same country, same time period. Two completely different outcomes. The only difference was whether they read the signal or not. I'm not telling you to run out and buy gold. That is not the point of this video. I do not give financial advice. Please talk to someone qualified before you make any decision. What I am telling you is that the signal is here, right now, screaming loud, and you have a choice about whether to hear it. There's another layer to this that most people miss. Everything I haven't talked about so far has been happening on top of another shift. The rise of alternative systems. Groups of countries have been quietly building payment systems and trade arrangements that do not use the United States dollar. This is not conspiracy talk. This is publicly available news. Nations that used to settle their oil trades in dollars are now settling them in other currencies. Trade agreements are being signed that specifically bypass the dollar-based banking system. Alternative reserve arrangements are being tested. None of this makes headlines the way a stock market crash does, but every one of these steps is a brick being pulled out of the wall that has held up the dollar's global position for 80 years. And when enough bricks come out, walls fall. This is why the parallel to 1971 is so precise. Back then, the alternative to Bretton Woods was uncertain. Nobody really knew what would replace it. That uncertainty gave the old system extra time. Today, the alternatives are further along. They are not fully operational yet. But they are not just theories on paper either. They exist. They function. They grow. That means when the next Kenneth Dam moment happens, when some official institution formally admits that the old system cannot honor its promises the way it used to, the transition may move faster than anyone expects. Because unlike 1971, there's already somewhere else for the money to go. Let me be honest with you about something. I'm not sitting here trying to scare you. Fear is a bad investment strategy. Fear leads to panic, and panic leads to terrible decisions. What I want you to feel is not fear. It is clarity. Because clarity is what protects people during transitions. Clarity is what separated the people who survived 1971 to 1980 with their wealth intact from the ones who did not. Clarity means you understand what is happening. Clarity means you stop trusting the surface story and start doing your own arithmetic. Clarity means you look at your own savings and ask honest questions. What is my money actually invested in? Is my wealth spread across different kinds of assets? Am I depending too much on a single currency, staying stable forever? Do I have any protection if the numbers on my statements start losing their real value? These are not scary questions. These are grown-up questions. And people who ask them ahead of time end up in a much better position than people who ask them after the fact. I want you to think about the older generation for a moment. Your parents, your grandparents, anyone in your life who lived through the 70s. Ask them what it felt like to watch their savings shrink year after year while the news kept telling them everything was fine. Ask them what it felt like to save carefully their whole life and then discover that the money did not stretch nearly as far as they had planned. Ask them what advice they wished someone had given them in 1968. You will hear stories that sound uncomfortably similar to the situation many people are quietly slipping into today. That is why understanding history matters. Not because history repeats exactly, it never does, but because history rhymes. The instruments change, the players change, the technology changes, but the underlying human patterns, the promises that cannot be kept, the arithmetic that eventually catches up. The sudden Sunday night announcements that change everything, those patterns show up over and over again in different clothing. All right, we are getting close to the end. And this is where I want to give you my third and final ask. Before I do, I want you to know that the fact that you have made it this far tells me you actually care about this stuff. You are not scrolling. You are not on autopilot. You are trying to learn. That is rare, and I respect it. So here's my last request. It is not a like. It is not a subscribe. It is not a share. It is this. Turn on the notification bell. Because when the next signal in this story shows up, and it will, I do not want you to find out about it 3 weeks late from a headline. I want you to be one of the first people to see it broken down clearly. Turn on the bell so you never miss the next chapter of this warning. That is all I ask. Now let us finish this together. Here is the final piece I want you to understand, and I want you to sit with it for a moment. The dollar losing its dominant status does not mean the United States collapses. It does not mean the economy vanishes overnight. It does not mean chaos in the streets. Big countries lose reserve currency status all the time in history. Britain lost it. The Dutch lost it. Spain lost it before them. Life went on. Economies continued. But the ordinary citizens of those countries went through very difficult transition periods. Their savings did not translate as well. Their imports became more expensive. Their standard of living adjusted. Some parts adjusted fast. Others took a full generation to work out. That is what a reserve currency transition looks like from the inside. Not a movie-style apocalypse. A long, slow adjustment where the people who prepared handle it far better than the people who did not. Gold at 3,000 and climbing is telling you the adjustment is already underway. The central banks stacking gold are telling you the adjustment is already underway. The declining reserve share is telling you the adjustment is already underway. The Moody's downgrade is telling you the adjustment is already underway. Every one of these is a candle on a birthday cake for the old system, and the cake is getting harder to see behind the flames. The 1971 lesson is not really about gold. It is about paying attention to signals when they still have time to help you. Kenneth Dam knew the truth on August 14th. The signal had been out there in the London market since 1968. The people who read the signal early had 3 full years to prepare. The people who waited for Nixon's announcement on television woke up the next morning already behind. Today, you have the same choice they had. The signal is here. It is not hidden. It is not encrypted. It is not being whispered in secret. It is being screamed out loud in the price of a metal that has been used as money for thousands of years. Every time gold breaks another record, it is repeating the same message. The gap between what the system claims and what the arithmetic underneath supports keeps getting wider. I do not know when the modern Kenneth Dam phone call happens. I do not know when the modern Sunday night television announcement arrives. Nobody can time these things precisely. But I know that when it happens, you will not want to be someone who says, "I had no idea. I did not see it coming. Nobody warned me." Because you have been warned. This video is that warning. History is that warning. Gold is that warning. The people who protect themselves during transitions like this are not the smartest people. They are not the richest. They are not the ones with insider connections. They are the ones who took the signals seriously when the signals were still just signals. They are the ones who did not need permission from a headline to trust their own eyes. You do not need to be a genius to survive this. You just need to be awake. You just need to notice what is right in front of you. You just need to be willing to ask honest questions about your own money and your own future before the answers become obvious to everyone else. August 14th, 1971, was not the day Bretton Woods died. Bretton Woods had been dying for years. That day was just the moment the old system finally stopped pretending. There will be a day like that in our own time. It might come from a rating agency. It might come from a foreign nation. It might come from an announcement that seems technical and boring on the surface. But when it comes, it will be the moment the pretending stops. And after that moment, everything moves fast. Between now and that day, you have time. You have information. You have history as your teacher. You have the signal of gold blinking in bright letters right in front of your face. What you choose to do at that time is the only part of this story that you actually control. So let me leave you with the question I want you to carry with you after this video ends. If you knew for certain that a Sunday night television address like Nixon's was coming in the next few years, what would you change about your money starting today? Not next month, not next year, today. Because the people in 1971 who acted on that question in 1968 protected everything they had built. And the people who waited for the announcement to arrive found out that by the time it arrives, the door has already closed. Sit with that question. Take it seriously. Talk to people you trust. Do your own research. Look at your own numbers with honest eyes. Because gold is doing exactly what it did in 1971. And history has been very clear about what happens next for the people who did not listen. You still have time to be one of the people who did. Do not waste it.